Have you ever sold a bear call spread and wondered when to pull the trigger and exit to capture that maximum profit or cut your losses? Well, in this video, I'm excited to show you how and when to exit bear call spreads so that you can consistently make the most money possible while limiting your losses. I'll also show you the filters that I use to screen for bear calls, kind of like my secret sauce that has worked best for me based on my experience trading stocks and options since 1999. Okay, so last week, a member in my Discord community was asking about when is the best time to exit a credit spread and if it's a good idea. Well, yes, it's a very good idea to think about that in advance. Now, I got into selling credit spreads as a way to understand how to sell options with a smaller account or with limited risk. But one thing I learned is that one trade could wipe out 6 months worth of profits in one shot. Not only that, as a beginner, if I waited too long, I found profits could go to zero, and if I exited too quick, well, I could be leaving money on the table. Now, I encourage you to watch this video to the end. That way, you'll be able to put all of this information into practice within your own brokerage account. And of course, if you have any questions during the video, drop them in the comments below or join me on Discord. And of course, I'll be happy to answer all of your questions. So without further ado, let's get started. Okay, so a bear call spread is an options trading strategy that involves buying and selling 2 call options that generate a net credit. This net credit represents the premium that you receive, and it's the maximum amount of profit that you as a trader could potentially earn from the trade. The goal in trading bear call spreads is for the short option to expire out of the money. That way you get to keep the credit. Now, there are many types of credit spreads, but the most popular and easiest ones to understand are the bull put spread and the bear call spread. And of course, for this video, I'm going to be covering the bear call. So the bear call aims to profit when the market is moving sideways or downwards. And with this strategy, you can sell a call option at one strike price and of course buy another call option at a higher strike price. Again, both with the same underlying and expiration date. Now, the premium collected from selling the lower strike price is going to be greater than the premium you pay for buying the higher strike call, leading to a net credit. Now, the key is to time your exits perfectly, especially for loss. So now, let's look at a real-world example of selling a bear call spread and how to set an exit point. First thing we want to do is screen the market for a potential trade. Now, I like to use Barchart for this as it's an inexpensive platform and the amount of data and customizing ability that you can do, well, it's second to none. And if you'd like to support the channel, go ahead and scan this QR code or check the link in the description for a link to a free trial. That way you can follow along with this video. So I'm looking at selling a bear call. Now I'll head on over to Barchart and screen the market for some potential trades. First, I'm going to start by removing some of the filters that I don't actually need. Then I'll add OTM probability, which tells me the chances that the short option will expire out of the money. I'll also add the risk-reward ratio as well to ensure that I'm not risking too much capital. Next, I'll add moneyness on leg 1 to get options that are already out of the money. And I'll add a maximum loss condition here as well. Okay, so here I'll change the drop down to less than and place a 2. This means the maximum loss on the trade will be $200. Next, I'll set moneyness to OTM, or out of the money. This will be for the first leg, or the short call that you'll be selling. Then, I'll change this drop down to less than for risk reward and enter a value of 3. This means the profit to loss ratio will never be higher than 3. Next, I'll enter 70 for OTM probability because we want our option to expire out of the money. I'll also set the days to expiration at 60 days. And finally, check the weekly box so that we also get weekly options in the results. By the way, this is my personal screen that I find works really well for me and helps ensure regular profitable trades. Of course, you can adjust the filters exactly as you like. And you can also hit the Save Screener button so that you can use it again and again in the future, and even have Barchart scan the market daily for you and send you an email with the results. Pretty cool, eh? So here we've got 11 potential trades, and this is really good. It goes to show you that this screen is super specific. We don't want thousands of potential options trades to choose from. Now, you can organize the trades based on these headlines, like break-even chances, or OTM probability, which is my favorite. And when you click it, you can see that this PayPal trade flows right to the top. So here you can see that PayPal's current trading price is $58.97. For this bear call, the suggestion is to sell the $62.50 strike call expiring August 16th and collect $2.04 in premium. Then buy the $65 strike for $1.40 with the same expiration. And the net premium works out to 64 cents a share, or $64 a contract. It also has a maximum loss of $186 and an out-of-the-money probability of 75.48%, which I think is a pretty good mix of risk and reward. So here's my strategy. First, I like to sell credit spreads expiring about 4 to 8 weeks away, with a 70% chance or more of expiring out of the money. In terms of exit points on a credit spread, I prefer to exit if the trade loses about 50% of its maximum. Last, if I can capture about 80% of the maximum profit potential and move on, well, bingo, that's exactly what I'm going to do. So these are my entry and exit points. And depending on the brokerage, you can attach an order so that when you sell your spread, you can now specify your exit point. So how do you enter the trade? Well, each brokerage is going to be a little different, but what you're going to want to look at is the ability to add a stop loss order entered at the same time that you execute the trade. So Interactive Brokers and others offer this, and I'm sure others do as well. So with the PayPal trade, remember your credit was $64. This is what the profit and loss would look like when PayPal stock moves up or down. And notice how if PayPal stays below $62.50, you get to keep all of the premium. But if it begins to move above $62.50, you start to lose some of your premium until you hit your maximum loss condition, which is $186. The key here is to set your stop loss point. And the brokerage will want you to enter this based on the premium. So the first thing we want to do is start entering the order in the brokerage. Here, I'll find the PayPal options chain, and I'll pick the 62.50 and 65 pair, expiring August 16th. And here, it shows your maximum loss is $184 and a maximum profit of $64, which matches what we saw earlier on Barchart. Now, we can hit order and enter a limit price, and remember, the value will be per share, so I'm going to put negative 0.64 as it's a credit to me. And then I'll attach a stop loss. So as I said before, I like to limit my losses to around 50% of the worst case scenario, which in this case, half of $186 is $93 or 93 cents a share. So I'll enter in negative 93 and set the order to good till canceled. One thing to note, these are stop loss orders, not limit orders. So once the stop is hit, a market order will be generated to exit the trade. So it's still possible that you may not get your stop price. But by having that stop order in place, you'll have better chances of keeping more money in your brokerage account, especially if the trade starts to go against you. Now, what about profits? Well, historically, I tend to close my trades on my own. In this case, if I could close the trade out for 70 or 80% less, then I do that. That would work out to buying back the trade for around $19, meaning I'd keep 45 and then I'd be on to my next trade. In this case, when the premium moves down to around $19, I'd take the profit. And personally, I prefer to take profits manually because I find that the maximum loss is much more important to be paying attention to, at least in my opinion. All right, so that's what I've got for you today. I hope you've enjoyed it. I hope you learned how I screen for bear calls and how I exit them. And of course, if you have any questions, don't hesitate to leave a comment below. Or if you haven't already done so, feel free to join me in my community on Discord. Bye.